Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones with our February monthly market update. Before I begin, I want to thank our valued clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. We want to congratulate Ann, who joined us in January of 2006, who's now been with us for 17 years. We recognized her a few weeks ago at our quarterly investment forum, where we had over 100 clients attend at lunch over Perry's to talk about markets. It was great to see many of you there. So as we turn the page in 2023, this is still what maybe a lot of investors are looking like. So before we get into 2023, let's look at a little bit of what happened in 2022. What's interesting about this cycle of emotions that we've talked about before is that whenever you feel the best is when you're at kind of the point of maximum financial risk. And whenever you feel the worst at the bottom of the market is when there's the best forward opportunity. So it's ironic that this is kind of maybe where you felt in beginning of 2022. And maybe by the end of 2022, you're here. But again, it's the inverse as it relates to maximum financial risk up here and best forward opportunity here. To recap what happened in 2022, markets were down as much as 25%, measured by the S&P 500, closed at about down 19. And volatility was up. So we had 46% plus or minus 2% days in 2021 or 2022. Contrast that with only 7 in 2021 and 44, so about the same during 2020. So there's always a reason to sell stocks. Stocks are bad sometimes in days, months, and a 3-month period. I'm going to focus on the 3-month period to talk about, since going back to since 1950, what the worst 90 days was historically. And you see that on average, during those worst 3 months, the markets are down 21%. And this is the time frame that we experienced a similar negative in April to June of 2022. What's interesting about those periods, again, going back to 1950, is that the average return 1 year later is 28.5%. Now, stocks are off to a good start in January. We'll see if that holds. The NASDAQ was up 11%, the best month since 2001. The S&P 500 was up over 6%, and the Dow up about 3%. So all major indexes on the equity side up year to date, end of January. Markets are responding to some of the same themes that drove the market last year, inflation being a key component. You'll see inflation is still relatively hot at 6.5%, but down from peak in the summer of 22, up over 9. And whether or not we achieve peak inflation is relevant for this information, which is, if we go back to 1926, almost 100 years, and we look at other peak inflation periods, on average, stocks and bonds the next 12 months are up 21 and 7. Now, it's not certain that we peaked at 9.1, but we've gone down a pretty good distance from there. So if we have peaked, this is an interesting historical guide. Now, the Fed has been aggressively at work to target what we looked at in the prior slide, which is inflation. These are the 7 interest rate increases in 2022, and then 1 in 2023, marking the 8th consecutive interest rate increase. And the benchmark rate now sits at 4.75. Now, if we view that the Fed is closer to the end than the beginning, I think the Fed will continue to raise rates at least most of 2023. But if you look at in the markets following the last interest rate increase, you'll see that on average, stocks up 20 and bonds up 11.5 following the last interest rate increase. Now, again, we don't know when that is going to take place. Likely the Fed will raise throughout the year. But once the Fed does raise interest rates for the last time during a hike cycle, these are the average returns over the next 12 months. And again, this data goes back to 1994. So the debt ceiling is we've already heard the beginnings of that. This will become kind of at its apex in June now, which probably means that it won't get solved until sometime in May. But the debt ceiling debate is a relevant debate because the debt is an important debate. 31 trillion is the U.S. debt as we sit here today, and this is debt as a percentage of GDP. So that's going to be a headline grabbing item as we move into the summer and something to keep a close eye on. Another thing to keep a close eye on this year is a recession. The likelihood of a recession has picked up. This was at the end of last year. Roughly 2/3 of economists believe there'll be a recession in 2023. What we don't know is how severe the recession will be, how long it will last, and whether the market's already priced in at least a mild recession. So that's also something to keep an eye on. Last year, this was kind of the quarter-over-quarter GDP growth rate. So we ended at just under 3 last quarter of 2022. The consumer drives 70% of consumption. So how the consumer is faring is relevant. A couple of things to look at here, which is the debt service ratio has picked up as interest rates have gone up. So the cost of borrowing is higher now. Also, that excess savings that accumulated during COVID is starting to be burned off, and the likelihood is that that will be completely burned off by the summer of this year. So these are also important things to watch as, again, the consumer drives 70% of GDP. We had a super hot jobs number most recently in January, over 500,000 jobs added. Again, this is a case where probably good news is bad news as it relates to the Fed, because it likely means that the Fed will continue to raise interest rates more aggressively because of a hot jobs market. Now, the jobs market is mixed in that there's still a lot of job openings. So there's 1.82 jobs for every job seeker. So there's still an imbalance as it relates to employment. And you're starting to see pickups and layoffs just within tech. Just under 100,000 workers have been laid off in January. So employment is also something to keep a close eye on in 2023. And we want to end with kind of a long view here, which is this goes back to 1926, and it just looks at time in the market in terms of how many of those 77 years markets were up and how many they were down. All of these negative 26 years, including last year, are painful to go through. But they're overwhelmed by the amount of time where the markets are up. So 71 out of the 97 years markets are up. And when it's up by about 2 to 1, 21% is the average positive year, and negative 13 is the average negative year. So this is just to kind of keep everything in a zoom out, longer term perspective. So we encourage you to contact us and never leave a question unanswered. We're here to serve you. Again, the best part of our day is time spent serving you. So please contact us if you have any questions. With that, we'll close. We wish you and your families the very, very best. Please contact us if we can help in any way. Until we see you again, be well and take care.